The Bureau of Labor Statistics just published the May Consumer Price Index, and buried inside it, motor vehicle insurance hit the highest cumulative level in 17 years. The news says the national average is moderating. In 4 states, premiums have effectively doubled since 2020. Here's the test that tells you which side of the state you're on.
Somewhere in New Jersey this month, a working person sat at the kitchen table, looked at a car insurance bill they could not afford, looked at the rent and the grocery receipts sitting right next to it, and made a quiet decision. The car still starts without insurance. So they let it lapse. They are not reckless. They just ran out of money before they ran out of bills. And here is the part nobody tells them. The moment they drop their coverage, your premium goes up because now you are the one paying to protect yourself from them. Stay with that kitchen table because 3 things are about to come clear. Why car insurance really climbed in the first place, and why it is not the simple story you have been told. The spiral that kicks in when squeezed, people give up and start driving with no coverage at all. And the one choice that now controls your premium more than your zip code and more than your driving record combined. This is general information, not financial advice, and I am not your advisor. So take this as a map, not a personal plan. Now, you have probably seen the headline saying, relief is finally here. And nationally, that part is true. The average full coverage premium actually fell about 6% last year to roughly $2,100 after a brutal stretch where it jumped almost 50% in just 3 years. 39 states saw prices drop. But that national average is hiding something because the country has split into 2. In Wyoming, drivers saw their average premium cut by about 30% in a single year. In Iowa and Arkansas, more than 20% each. And the typical Arkansas driver finished the year paying around $550 less than they started it. Meanwhile, in New Jersey, premiums rose 20% in 1 year, on top of 10% the year before. In Washington, D.C., they climbed 18%, making it the most expensive place in the country at just over $4,000 a year. Rhode Island and Michigan posted double-digit jumps too. Same country, same year, opposite directions. And the thing that decides which side of that line your state lands on is mostly not your driving at all. It is your state capital. You are on the climbing side if your state forces insurers to wait in slow approval queues to change a price. So heights that were filed back in 2024 are still landing in mailboxes today, long after the costs behind them peaked. New Jersey is the textbook case, where regulators approved more than 60 double-digit rate increases in just a few years. Some companies asking for hikes north of 40%, while a stack of new state laws made accident lawsuits more lucrative and pushed the whole market higher. You are on the relief side if your state lets insurers file and use new prices quickly, or simply has a pile of carriers fighting over your business. The common thread on the cheap side is light traffic, low theft, fewer uninsured drivers, and rules that let prices move fast in both directions. So everyone blames inflation. Why is a simple fender bender suddenly a financial event? The biggest reason your premium climbed is sitting in your driveway. It is the car itself. Modern vehicles are now rolling computers packed with cameras, radar, and sensors tucked behind nearly every panel. So a minor crash that used to cost a few $100s to fix now runs into the thousands. The folks at AAA measured it. The sensors and cameras that run those safety systems can add more than 1/3 to the total repair bill, and a minor front-end bump on a sensor-loaded vehicle can run past $5,000 to fix, more than double what the same crash costs on an older car. Electric vehicles are worse, with battery packs and parts that are pricey and hard to source. So the same coverage on the same street can swing roughly $1,400 a year, just based on whether you drive a plain work truck or a tech-heavy EV. That means the machine in your driveway is now a bigger lever on your bill than the city you live in. Then stack on rising repair labor, higher medical costs, and bigger lawsuit payouts, and the price climbs whether or not you ever file a single claim. Now, the comforting story is that prices are moderating, so this just fixes itself. It does not, because the people getting crushed are not in that national average.
Hey, real quick, I want to throw out an offer. I put together 2 courses that could change the game for you when it comes to making money. That is the Money Mindset course and the Dominate Debt course. Absolutely game changer. If you're in debt or you're wanting to learn how to make money and change the way that money has a hold on you, or maybe you just aren't there. You're not the lucky one. You don't understand how other people are making, you're not. This is an absolute game changer for you. Links down below to both courses for one low price. Now let's get back to the video.
Even as the average eased, about a third of drivers still say their insurance is flat out unaffordable. And when a bill breaks a tight budget, those families do not shop smarter. They drop out. Watch what that actually does, because this is where it turns into a do loop. The people who study this say it is not really about reckless drivers. It is about math. J. Robert Hunter, a former state insurance commissioner who now tracks affordability for the Consumer Federation of America, puts it bluntly, that the uninsured problem is far more about affordability than irresponsibility, and that the factors insurers lean on, your job, your education, your credit score, quietly push lower income drivers right off the rolls. The people who work with those families see it up close. Marty Schwartz runs a nonprofit that repairs donated cars and gives them to working families. And he will tell you the insurance bill now often costs more than the car payment itself. And the dropouts are real and measurable. In one 6-month stretch, J.D. Power found 12 states where the share of uninsured drivers jumped 30% or more, and 2 where it spiked by over 80%. In New Jersey, the uninsured share went from 3% before the pandemic to more than 14%. Here is the consequence, and it lands on you. Every uninsured driver is now a risk the insured have to cover. So insurers raise the price of uninsured motorist protection, which squeezes the next household out, which lifts rates again. It is a loop, and it hits the people who can least afford it first. The tradesman who needs his truck to work, and the rural driver with no other way to reach a job. There is one more layer, and it quietly ties your car insurance to the stock market in a way almost no driver realizes. Insurers do not just sit on your premium, they invest it. When the markets are strong, those investment gains give them room to hold rates down or even cut them, and that is part of why prices fell last year. But when markets fall, they lean harder on your premium to stay afloat, and rates climb. So a stock market downturn would not just bruise your retirement account. It can land a second time, months later, right in your car insurance bill. The cost spiral is structural. The uninsured loop feeds it, and a market drop pours fuel on both. When an essential bill doubles like this, the answer is not panic. It is a plan, and that is the budget rotation inside Money Mindset Mastery and the Debt Priority Ladder in Dominate Debt, both linked below. Again, general information, not financial advice. So most of this is out of your hands. Here is what is actually in them. First, understand the cost of the lapse. If you drop coverage to save a few dollars a month, one accident can wipe out years of savings and then come after your wages on top of it. Dropping out feels like the cheap move. It is the single most expensive move on the board. Second, the vehicle is your real lever. Before you buy your next car, price the insurance the same way you price the monthly payment, because a cheaper to insure vehicle can save you more every year than any discount code or loyalty deal ever will. Third, treat your credit and your renewal date as tools, not afterthoughts, because in most states, both quietly move your rate and a strong credit profile in a well-timed renewal can shave real money off the bill. Fourth, keep one eye on the market. If it turns, the smart move is to lock in and shop your policy before the next round of hikes rides that downturn into your mailbox. So go back to that person at the kitchen table who finally let their policy lapse. Now multiply them by millions and picture the road you drive every single day. More and more of the cars in the lanes around you carrying no coverage at all. Every one of them, a bill quietly waiting to land on you. The real crisis was never just the number printed on your statement. It is who is no longer protected in the lane right beside you. And when the next squeeze driver with nothing left to lose drifts into your bumper, The only thing that decides whether you walk away whole is whether you are still the one who is covered. The repair cost data, the uninsured driver rate in your own state, and the carrier's investment exposure all start moving before your premium does. Those three are what we watch here, so you can see the spiral turning before it ever reaches your driveway. Economic Ninja is out. Stay informed and stay protected.